Ladies and gentlemen, good day and welcome to Q2 and H1 FY25 earnings conference call of Honasa Consumer Limited, hosted by JM Financial Institutional Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mehul Desai from JM Financial Institutional Securities. Thank you, and over to you.
Thank you. Good evening, everyone. On behalf of JM Financial, I'll welcome you all to Honasa Consumer Limited's Q2 FY25 earnings conference call. From the management side, we have Mr. Varun Alagh, co-founder and chairman and CEO of the company, Ms. Ghazal Alagh, co-founder and chief innovation officer, and Mr. Damanpreet Sohi, Chief Financial Officer. I'll hand over the call to the management for their opening remarks and a quick presentation, post which we can open the call for Q&A. Over to you, sir.
Hi, thank you, Mehul. Hello, everyone. Welcome to the quarterly performance call for Honasa Consumer Private Limited. I'll just set some context and highlights. We have released, of course, the results of the presentation alongside. I'll quickly recap some of the pieces that we have mentioned in the presentation, and post which we will open up for question and answers that you will have. I think, if you look at the presentation, we've started by sharing the fact that we acknowledge the fact that the environment, consumer behavior, and distribution are changing quite fast, especially in the Indian context. Some of these trends were already happening. Some of these trends, like the way media landscape has quickly changed, the way consumer proclivity and propositions have changed, or how quick commerce is impacting consumer behaviors, are things that we are also seeing as relatively new changes, to which one's models and thinkings would, of course, need to evolve. And in light of that, we've also talked about the 4 or 5 key areas, which are areas that we're focusing on, where we believe we need to rethink some of the strategies and calibrate and evolve them in line with how we're seeing the landscape evolve. Of course, the first one is this whole amazing brand building playbook that we've built out. While that brand building playbook has done really well for us in terms of scaling brands from the 0 to 1,000 crore journey, we've seen that happen for the other brands that we built as well. But the 1,000 to 2,000 crore journey, it seems that we were trying to deploy the same playbooks. Whereas over the last few quarters, all our sort of data seems to be pointing to the fact that we need to evolve those playbooks in line with how to win with the consumer who is buying offline, and the kind of media that they're sort of looking at, and the kind of distribution that is required to get that done. And a lot of work is happening on that front. The other learning that we've had, which is something that we've already started executing here also, is that winning in beauty and personal care, which is a complex sort of landscape of over 24 subcategories, will happen a few categories at a time, right? And we need to dominate in those categories, and then keep adding more categories where we become leaders and dominate them. And the whole strategy of House of Brands will help us do that. But that will also mean we need to focus investment, innovation, R&D, etc., far more on those categories rather than going too wide. And in a phased approach, hence look at sort of winning in BPC. A third area of learning, which we are also again implementing as part of Project Wave, has been the entire area of offline GTM. I think this is an area where we clearly recognize that this is something which needs to be relooked and as the need and scale of your business over time changes. I think even if I was to go back, and I don't think we would be able to start with a different kind of a distribution system, because at that point, with a zero business and no regional supply chain availability, that was the best system that worked for us. But we clearly, now when we look at it from the next 4 to 5 year horizons, where multiple of our brands need to go through this funnel, we clearly feel that the distribution system required for that is different, and that's the area where we've been dedicatedly working on. And as we build this out, as we evolve, and probably another 4 years down the line, we will need to again look at the same from a next 5 years business need perspective, right? And that is something which is an evolving muscle rather than a straight line skill that we have experienced. The other area which we clearly have learned and are executing is brands need to remain sharp to what they stand for. But our investments in the brands, depending upon the different consumer cycles, should and would vary. As we speak, for example, in a channel like online, the proclivity towards active and derma brands is far higher compared to naturals. And we have different brands to play on to those different propositions. And we need to invest accordingly to win in the category, right? And to make sure that we're able to gain share in the category in the most effective way, right? While offline might be a different sort of consumer proclivity. But at no point of time we want all our brands to start speaking the same language. We want them to be sharp on their own propositions, but in line with consumer proclivities, change investment strategies to win in the categories. I think that is something that we've also sort of realized. And another area that we've been consistently working on is product superiority. And we have been actively investing in R&D capabilities, partnerships. And our objective here would be that, we build capabilities that in all our focus categories, our hero products actually beat the competition in blind testing. And that's an area where few of our products are already there. But it's a constant journey through dedicated investment that we are going to continue to be on from an organization perspective. Now, from a quarter 2 and half 1 perspective, I think there are 2 areas where we recognize that our outcomes have not sort of gone in line with our expectations. One, of course, is the impact of the sales returns and the inventory correction that has come through, which is higher than what we had imagined it to be. Because as we went into executing that, we clearly realized that there were pockets of sub-distributors or market credits which we had not taken into account. And given these are now full and final parting exercises, the impact has turned out to be higher than what we had imagined it to be. But we did not want to do it half-heartedly. We wanted it to be a clean execution, and hence we've been aggressive as well as conservative in our approach towards that to take a higher impact. I think the second area where again our assumptions have not panned out in line has been the growth for Mamaearth. We have been analyzing that. Like I said, I think the model that we were trying to execute was very similar to what has worked for the brand in the past. We have recognized that there are a few strong tweaks that we need to make across the mix, from product mix perspective in terms of SKU sizing that needs to be sort of promoted, to communication perspective where we need to become sharper, to even most importantly on investment allocation. where I think our learning is that we've gone too wide and we need to narrow our focus onto a few categories and go deep within them with our hero SKUs. And there is a very strong and active charter of body of work, which is, as we speak, we're all sort of part of, right? And this is absolutely the number one priority for us, and, to recognize what all changes need to be made. And action them in form of pilots regionally or at category levels. And this is those learnings with a scaled-up strategy to bring Mamaearth back to a strong growth path. For some time, we kept sort of, mentioning this was more because of the base effect of the brand. But we clearly recognize that there are structural changes to our execution plan that we need to do to actually make things work. And if this starts working, hopefully the brand will actually be able to grow stronger than what we imagined in the past. I think we're going to approach it from that perspective. Of course, outside of these two things, the young brands continue to demonstrate very healthy growth. Each one of them at H1 and quarter 2 level also have grown at 30% plus, which is a great sign for the company as they scale and become much larger. These are also brands which are not as impacted by the offline transition. That is also sort of visible there. In other parts, again, something which is clearly showing result for us is our focus category strategy, because our focus categories put together have actually done very well. Our three strongest categories where we have the best shares, and addition also is the strongest in those two categories, which is face cleansing, serum, and sunscreen, have actually demonstrated 28% growth in half one. And we want to make sure that this focus category approach, we are able to extend that to 5 to 6 categories over the next 3 to 4 quarters, with which we will be able to showcase healthy, strong growth across a much larger contribution of our revenue portfolio. Where our ambition again will be to become sizable market share. I think broadly that's the highlight that we had from our side. Would be more than happy to answer your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to only use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Vivek M. from Jefferies. Please go ahead.
Hi, Varun and team. Varun, if it's okay, I have quite a few questions. Can I go ahead, and if you can allow me to, go for some time, is that okay?
Sure.
So, Varun, one thing on Mamaearth as a brand, I heard what you said on the call, and, you have been transparent, today. My question to you is Mamaearth, the problem is it the size which is an issue for Mamaearth, you think? Because when you started Mamaearth as a brand, or the other brands, there are some problems in whichever form and shape FMCG companies are also facing. Do you think Mamaearth also as a brand has hit a scale which is, which has become sizable, and because of which Mamaearth faces the same problem that, let's say, some of the larger FMCG company brands also face?
Vivek, honestly, I think at least our approach towards this has been, not to externalize it, and actually we genuinely believe that as a brand, given the kind of shares that the brand has in some of the subcategories of operation, it still has a long way to go. And hence, potentially, would the pace of growth be 15%? Yes, that is probably an area where the pace of growth can be lower, but sustainable growth from a long-term perspective, we still believe there is a long way to go for the brand to hit a ceiling. And, while short-term demand pieces could be there, but we wanted to look at it more structurally. And that's the exercise that we've been doing over the last 3 odd months in terms of understanding structurally where could we be missing the trick, right? And for example, one of the areas which I touched upon, which is investment allocation, right? We realized that we were allocating an investment, in our investments over 10 different categories in Mamaearth, right? And that was too wide a dispersion of investment which was happening, and our hero SKUs and categories were actually getting suboptimal investments because of that. And that's a clear recognition that we have had. And even in the we talked last time that from a offline playbook building perspective, we brought Bain on board to also share some of these learnings and help us see it through that framework perspective. And we have clearly seen some of these areas where we could do significantly better and growth back on track, right? So in my view, I wouldn't want to at all believe that the brand is hit the ceiling. And we are very, very clear and confident that this will become the number one skincare brand in the country over the next 5-7 years. And we just need to get our game right to sort of get it there. And that's the body of work which we're actively doing.
Okay. And on the same lines, your own presentation slide mentions that Indian consumer shifting from family-oriented to individual-centric consumption, which also means that there is a fragmentation happening in the market and platforms are evolving, etc. Do you think that because the entry barriers are low, Mamaearth as a brand is in some ways you have answered partly, but the entry into this category will keep happening from new players, from new brands over time. Does that mean that you'll always be on treadmill and you'll have to keep running and keep launching new products, or is there also a risk of a boredom with a brand because there is something else which has come in the market on the online side, for example?
Vivek, what we are clearly realizing and recognizing is that online and offline are going to be very different ball games, and one fit all strategy will not work. To your specific yes, the entry barriers and hence the competitive intensity in the category is higher, and which is visible more in the online world, and hence innovation is important when it comes to online business. But when you look at the offline business, which is what we are clearly recognizing and realizing, that's still a very heavy hero product business, and where most of the players have hero products and portfolios in specific partitions, and which continue to have large share. Segmentation has not happened in the offline space as much as it is happening in the online space. And for Mamaearth, where a large part of the growth delta is now supposed to come from the offline consumers, and getting that game right is very critical as we move forward, and which is where optimal investments on hero products, getting them in the right sizes, distributing them in the places, and focusing very strongly on that is something that we will need to dial up. And I think we've talked about this in the past as well. Innovation is something which is table stakes as we move forward in the online ecosystem. I think companies which are not able to innovate will sort of will not be able to win the online game as much, and that is something that we consider our strength, and we continue to do that well. And the only thing that we talked about and recognized is that the way we want to look at this business is from category out perspective rather than brand out perspective. The objective is to become top 3 in share in face washes, number 1 in sunscreen, number 1 in serums, and get into top 3 in another couple of categories that we define for ourselves, and nationally, and not just in online. But in that category, different brands at different points of times and might have different sort of roles to play. And like I said, at this point of time, active as a proposition has been in favor with the online kind of consumers, right? And hence, using Dermaco and Dr. Sheth's to get share in face wash as a category while a Mamaearth might be at hold and might be a more beneficial strategy. But as long as we are gaining category shares, and is what the investment should be aligned to, right? Is what we are learning from that whole approach. But innovation to a certain extent in all categories is a table stake for all companies.
Got it. One, pardon me for asking this question directly to you, but because you mentioned about offline, you mentioned about playbook 1 to 2,000 crores and all. You need a different playbook, etc. If I just ask you, what is your right to win in the offline space where there are FMCG companies which have been around for decades or centuries? How would you respond to that?
Vivek, finally, almost every couple of decades in almost every category, there is a generation shift that sort of happens from consumers, right? And that generation shift is actually an opportunity for brands to sort of take ownership and share in the usage amongst those generations, right? I think firstly there is clearly lack of brand choice which has been there in the country in the past, and that is not just for the online consumers but across offline consumers as well, right? It's in the entire consumer landscape where there has been dose of brand options, right? And in my view, right kind of brands built on right propositions is something where there is new brands have the right to sort of win there. And that is one area. Second is, of course, we need to provide products and propositions which are emotionally and functionally superior compared to what the consumer is using. And in certain cases, that could be because we are specifically crafting for the Indian consumer. For example, the right to win for an open face wash in its space is because there is clear strong association and credibility that the consumer has with the DIY recipe that has existed for centuries in India. And now there is a brand which is offering that and in a great easy-to-use format. And this is something that no other international brand is able to offer from their core DNA. And this is something that our brand is built on. And hence we will offer that and have the right to win from a product perspective. And similarly, in other in areas we believe from a product perspective, we need to have a concept which is a winning concept and not a me too concept. And but also in that concept deliver a product, like I said, which is a blind test winner in terms of product likability. That even if you remove the brand and the product against competition actually does better, right? And that's something that we can pursue work on. Of course, the third area would be, from a GTM perspective, in which case, at least in the short term, we will need to use a combination of velocity and higher trade margins to get customers to get used to selling and displaying the brands. And because for the customer, which is the retailer in this case, there are two key benefits here. One, of course, as you premiumize the category in our ASPs, in almost all categories are higher by 20-25%, and that gives the customer higher bill value per transaction, the retailer. And if your margins are higher compared to what they've been selling in the past, for the retailer, there is a much higher opportunity to sort of make better money, and especially in this kind of an environment where the overall business is under duress. A brand which is able to offer them much better return unit of sales is something that they would like to prefer. So I think combination of these three is what I believe will give us the right to win. And we are not even trying to become another deep distribution rate of the industry. We just need to get 200,000 direct outlets right. And if we are able to get that, this is where 80% of the weighted distribution game is being played. And that is where almost all of the mass premium proposition consumers are going to buy. So for us, we don't need to get millions of stores right. We just need to get the 200,000 right. And which, in my view, a focused approach towards that 200,000, we should be able to demonstrate and build for, and might be much higher compared to where someone is looking at a much deeper, wider kind of numeric distribution. So I think those are the things which we want to work on to make sure that we have a right to win compared to the existing distribution systems.
Got it. That was detailed. And just a couple of more, Varun. One is where you are in that cleanup cycle right now. So do you think the bulk of the cleanup is done, and now from here on it's the build-up phase, or there is still a fear of unknown that you still, or that you may still have as investors?
So Vivek, bulk of the cleanup is done, and this is also a structural change. So I don't know if we should call cleanup, but we just removed the layer from the distribution, right? And that layer, whatever stock that was holding, we had to, of course, take the impact of that. But from a distribution system perspective, and bulk of the cleanup that we need to do has already been done in Q2. And of course, the ramp up from here onwards is going to be slightly gradual, and will take a few quarters, because wherever we have, for example, you would define distribution in geographical ward cells, right? Even a city might have 6 to 8 ward cells, depending upon the size of the city and number of outlets that you're trying to cover. And currently, in about 70% of them, we have been able to deploy distributors. But there are at least 30% of the ward cells where we are still deploying distributors, and that will happen over the next 3 to 4 months, and basis which then coverage in those outlets in form of direct coverage will sort of get built up. So all of that scale up would be something that will happen from now onwards gradually, but all of that scale up is going to be fairly structural direct distribution scale up with a much better quality and transparency of execution.
Okay. And last one, do you think FY26 is where you start with a clean slate, and second half FY25 still will be somewhat volatile, somewhat weakish? Also, in the context of given urban consumption slowing down, do you think that also adds to the headwind?
Yeah, it's not been the best time to sort of, from seeing the genuine tests and experiments of outputs perspective. And there clearly seem to be some form or change in terms of consumers buying in patterns which are visible, but we genuinely want to see that as and understand that as a structural change. Right? We want to figure out what kind of things will work in that new environment, what do we focus on and build on. That said, I would agree with you that the build-up from here on would be slightly more gradual, and getting into next FY, we should be far more confident of all the experiments and changes that we are executing as we speak.
Got it. Varun and team, wishing you all the best, and hopefully we will see a recovery soon. Thanks.
Thank you.
Thank you.
We'll take our next question from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, Varun and team. I just wanted to know one data point, if you can give me. For the GT distribution, see, you have a DMS, so you know exactly how much the distributor is actually selling onwards to a wholesaler or retailer. So that secondary sales, so to say, what is the growth in that secondary sales for GT this quarter on a YOY basis?
Hi, Percy. Percy, honestly, the YOY number is not a number that we are ourselves able to also fully track, because last year DMS did not exist in the system. And it's only this calendar year that DMS execution started and has fully shaped at end of Q1 basis, which we were able to do some of these actions in Q2. Actually that from a secondary is not available. What is available and what we can share with you is the Nielsen data, which continues to be the same panel which existed. And if you look at the Nielsen data, then in the core categories, which is face wash and shampoo, the brand actually is growing fairly well. It's growing ahead of the other brands which we are competing with, and which is where the brand is actually gaining share as well, right? So both face wash and shampoo, YOY as well as sequentially, we have gained share. And I think that is probably a better indicator of YOY secondary group trend.
Got it. So in Mamaearth, you said that is the main sort of area of concern in terms of the slowdown. So just wanted to understand within Mamaearth again, what is the area of concern? So 2-3 options here. Is it that one particular channel is a issue? Whatever be the products being sold through that channel. So I mean, your own digital assets, you have anyways been defocusing, and that has been happening for a few quarters now. But despite that, the numbers were not as bad in the previous quarters. So is it a channel issue, either your own digital assets or even aggregators like a Nykaa, Amazon, where you are seeing a slowdown? So that is one option. Or as you said, there are some categories like face wash, etc., where you are doing very well. So is it that the Mamaearth brand is not resonating in some of the other categories, and those categories are seeing a big decline, bringing down the brand? Or is it some other issue altogether? So within Mamaearth, what is the problem area?
Firstly, let me sort of try and answer this one. So firstly, of course, GT is the biggest sort of contributor to the drop in line, because that's a place where we've been going under structural transition, and the primary bases are of a very different sort of kinds, and we now need to, with that transition, we've not been able to grow over those bases. So that's the biggest delta drop. And
if I might just get some clarification here, this GT is an issue even after you remove the 63 crores of sales return, or it is because of the 63 crore that it is pressuring? Because I'm keeping that as a one-off. So if I even remove that, even then the GT is an issue, is it?
So even after we remove it, and GT, of course, the issue reduces significantly, and but GT still continues to be an issue even after we remove it, right? MT is not, but GT is, and there, because GT is a sort of sort of inch by inch, step by step, outlet by outlet game, right? And if your core distribution infrastructure is not fully in place, then that's an area where we've not been able to hence grow the brand. And even in online, and from a even if you remove D2C, and the brands become more flattish now, and largely what we have experienced is that there is a proposition skew more towards actives, which has kind of impacted that to some extent, which we believe might be a more short-term wave. Over time, of course, most countries and geographies that we've seen naturals turns out to be a very long-term consistent proposition. And the other area which is specifically also touched upon, actually there are certain categories, right, which are declining much deeper, which are not focus categories for the brand, and which again will be a turn, and that will happen, that might impact negatively in the short term, but as we further strengthen our investments in some of the focus categories, and the growth rate of focus categories becomes even better. And I think they should be able to net overtake any drop that comes from non-focus categories. Currently, because we have not changed our investment allocation as much, that's something that is not showing up.
Got it. And see, the other brands excluding Mamaearth, is there any slowdown in the growth rate for those brands this quarter versus what we have seen over the last 3 to 4 quarters, or those brands are growing at the same rate as what they have been growing over the recent past?
Slight slowdown relatively is there, but in my mind, apart from potentially the demand play, the other factor is that our largest category is sunscreen, and there is a very high correlation that category has with the humidity and rains, right? I mean, a negative correlation, of course, and that is specifically one category where we've seen last quarter to be not shaping in line with what we sort of imagine it to be within the weather. But otherwise, the overall growth rates are fairly similar. There is a slight impact of these few things in Q2 compared to Q1.
Got it. And one last question, if I might be allowed. You said you need different playbook. Do you need a different playbook for media as well? Because as you said, now you have to look at the online and offline business separately. So for driving the offline sales, do you think that you need to pivot media also to offline, or do you think that online advertising can still sort of help with the offline sales as well?
But a very relevant question. This is again a body of work which we've been actively doing. And, so two parts. Firstly, yes, we do. That's one learning which has come out of the body of work that we have done. That our media deployment strategy needs to change. And, the changes are not only towards the type of media, but also how we deploy media, right? Where we were very impulse and seasonality focused, instead of which we need to be far more always on, right, in terms of our side of media on these focus categories. But also on media vehicle choices, where there is a detailed media mix modeling work that we are doing with our internal data science team, as well as MMM data science expert agency, which is working to tell us what part of our media is the strongest in driving sales as well as brand consideration. And through searches and combination of that will help us come up with a much more effective media strategy that we want to deploy getting into next year.
Thanks a lot for your patient answers, Varun. All the best.
Thank you.
Thank you, Harshil.
We'll take our next question from the line of Latika Chopra from JP Morgan. Please go ahead.
Hi, thank you. Hi, Varun. I think a lot of questions were already asked. I want to broadly check with you, is there any rethink on your margin ambitions of reaching double digits, as it seems you need to invest back into reviving growth for Mamaearth?
Latika, while in the short term, from a quarter-to-quarter basis, to experiment and get some of these media mix and funnels right, and you might need to skew things a little here and there, but our view on being able to get to high double digits and in the medium term, and for any companies to hold strongly. And in fact, one of the things that we've also learned from this exercise is that if we're able to build even stronger dominance in a few categories, our ability to generate higher margins in those categories also becomes stronger. And if we're able to unlock some of these hero products and GTs, and that should actually further help the margin calls. And so I don't think from a medium-term perspective that we changes. And of course, to get to that, the path that we were expecting in earlier, we was just continuing on the same path, we'll be able to get there. And that path we will need to sort of imagine and work on, which is the work that we're doing. And but the destination still continues to remain the same.
Sure. The second bit was, could you share some color on, the most recent brand that you launched, Stage, on the cosmetic side? Is this something which is still in test phase for you? Any thoughts there?
I think it's fairly early days on that brand, right? And the big difference between any of our other brands and that brand is that this is an absolutely new category, right, that we are playing in, right? And hence the learnings that we are, and not just the category, but also a different price point, to be honest. It's slightly in the mass plus kind of price area, not a mass premium kind of price area. And hence we've actually been learning a lot in terms of supply chain management, category innovation, media deployment, and how to do that for that brand. And that's the brand is scaled in line with our sort of expectations. And it actually is already at a 25 crore plus run rate ARR. And we believe we will sort of continue to learn on it and our basics even stronger to win in that category. And early days, but yes, good signs.
That's good to know. And the last bit was on these emerging brands which grew 30% in the first half. What kind of growth expectations do you anticipate for them, over the next 2-3 years? We did hear you mentioning, Mama did see some impact from actives, right? So it seems like Derma company should be doing fairly well. Any thoughts on whether this portfolio can maintain a 20-30%, 30% kind of growth band given our investment plan?
Your voice is breaking. Can you just repeat, please?
Sorry about that.
I'm sorry, Latika, I didn't get I got the question.
Okay, thank you.
Let me paraphrase. And you're saying what kind of a view do we have on the younger emerging brands? Do we believe they'll be able to grow at least a 20% plus kind of a pace? And actually, they're very confident, right? From propositions, categories, channels, and all of that perspective, not only are the brands growing, but they're also gaining share in their own categories of interest. And Derma especially has been doing phenomenally well, and again has a lot of scope to further grow. And we just entered the face wash category last year, and it is doing exceptionally well for the brand, and that's a category where we can see it becoming much larger as a play, and we'll continue to sort of work on that. And similarly for other brands, and there is clearly success that has been seen in one or two categories for each of those. And we continue to work on further strengthening and building those categories. But as they grow, there are also other subcategories which will open up for those brands, which will continue to fuel the growth. So as we stand feeling fairly confident of being able to grow all of them very well.
Thank you so much, Varun and Dave. All the best.
Thank you. We'll take our next question from the line of Manoj Menon from ICICI Securities. Please go ahead.
Hi, team. Quite a few clarifications, hopefully nuanced ones. Just on the playbook revisit, team, is it fair to make a statement of hypothesis that, you are absolutely clear about what doesn't work, but at the same time, not very sure about what will?
You're right. I mean, in terms of, we know that at least the last sort of investment in mix model was not generated the kind of growth that we needed it to generate. And now what we are trying to do as part of pilots is taking cells like, a one state or one subcategory and implementing a very different kind of a playbook on the same, getting into all of that is work is planned, starting now into Q4, and then seeing if it generates disproportionate results in that cell. And there are 8 to 10 such pieces which we want to activate in action, and to actually learn which cell sort of, and hence what kind of strategy works in which part. And, like I mentioned, I think we've been working closely with Bain on this, right? And we're getting some really insightful hypothesis on the basis of this, which these tests are doing.
Understood. Thank you. And moving on to Mamaearth as a brand, let's when I think about, let's say, the three brand key which you have, for the brand. Look, is it a case of, you did alluded to, but I just want to double click on one aspect that, just from a marketing point of view, not from a spends point of view or a support point of view, which you did allude to. Is it a case of, extendability, let's say, already stretch? I mean, is it that you went a little too far with the brand? The reason I'm asking this because at least I can't think of too many brands which have successfully straddled body, face, hair, etc., etc.
So that is of course one hypothesis, but I don't think we're taking it in the dimension of brand versatility and extendability as of now. What we are taking that in the dimension of is that versatility has come at the cost of underfunding core categories, and which is something that at this early stage of brand evolution and penetration, shouldn't ideally have been done. It should have been, getting to a certain optimal scale in one category, right, and only then sort of looking at investing in others, right? So while the acceptance in terms of versatility we felt was very high to the tune that even something like a Mamaearth lipstick does some 4-5 crore monthly business today. And so the versatility was there, but the versatility comes at the cost of going down in terms of investments, and that has not clearly worked. And versatility cannot sort of come at cost of suboptimally funding your core and focus categories is the big lesson. And in the long term, would the brand be able to demonstrate versatility? And I think we still remain confident on that. And, but we want to get there only after we have fully funded for. And there are multiple examples. I mean, Dove can be a good example, right? To Himalaya, to even a younger brand like CeraVe, which have straddled across 5 to 7 subcategories well. And, but the learning around opening one frontier when you sort of not fully captured another is a learning for us. So, and that's what we're going to deploy.
Understood. Just one last thing on the brand, let's say versus Mamaearth, which has been a high growth brand, or rather I would say in high growth phase, excluding the incident this quarter, etc. Versus let's say a reasonably mature brand of similar size or any other cut you want to take. What is the difference, let's say, as a proportion of, let's say, if 100 is a denominator, what is the proportion of, let's say, hero brands or rather hero SKUs, rather, stands corrected, for a Mamaearth versus some of the mature ones? I mean, how much gap that would be currently?
So, significant. I would say for most others, top 10 SKUs would probably, especially in the offline kind of environment, contribute to 75-80%, while for Mamaearth it will be about 40 to 45%. And hence there is, that's a clear opportunity that we see the brand needs to focus.
Understood. Thank you. And one last thing on the offline piece. Look, I think at least I was advising investors that, look, when a company moves from online to offline, it is fair to assume that since you start on a zero base, for some incidents to happen, and in a high gross margin industry or a category, it's always better to overstock rather than understock and lose the lifetime value. So that much is clear in my mind that, demand planning, you learn, right? I mean, you started on a zero base, and as each year goes by, you learn. The only question which came to my mind was, let's say, a conversation we had a year or two back about, let's say you have reasonable online data, which would have probably helped you to get the demand accuracy far better than somebody starting in offline for the first time.
Sorry, Manoj.
Hello?
We lost you. Sorry?
Completely?
Yeah, please.
Okay. No, what I was saying was, my chats with investors have been that, look, let's say demand planning, when you're going for the first time into offline, it is natural to have some incidents, etc. And again, because you started on a zero base, right? I mean, it's obviously as each year goes by, you learn the offline demand planning, accuracy will improve. The only question there was, the assumption, let's say we had a year or two back, was that since you had a reasonable amount of online data, I would have assumed that the demand planning accuracy is far better than, let's say, what actually happened.
Yeah, Manoj, I mean, like that's been a area of learning for us as well. Now when we sort of, at least a year back, and after that we of course corrected on our catalog. We did not, while we had a clear conscious what do we want to focus on strategy, but we did not limit our distributors or the system from ordering any kind of sort of products which were there in the system, even which they were listed in online. And for a long time, finally the retailer is also looking at Instagram. The retailer is also sort of checking on things on Amazon and seeing what is it that the brand is right now promoting and what is selling on online, and they all sort of realize that that's a competition. And our sales teams kept getting sort of that feedback from dealers, no, that this product is not there, you should stock this in my shop as well, and this product I'm seeing an ad on it. And that led to proliferation of the catalog compared to what we planned the catalog to be. And over time, of course, we clearly learned that offline is not going to be a search and buy kind of a shopper journey, but it is going to be a journey where the shopper already has some consideration of what they want to buy. They will come in and sort of buy, and hence a salience and focus on a few and in absolutely relevant need spaces and payoff spaces, and is a far more effective strategy compared to having many but not being salient in one. So I think that's also sort of been a learning, and we've already from systematically curtailed our ordering assortment itself now, and this is sort of the data and science.
Understood. One last thing on the distribution. You started with, let's say, stock is sort of a model, if you recall correctly, 3 years back. At least anecdotally, what I found that probably now you have a lot of class A, distributors. What I mean by is that, people have been in the distribution offline for a long period of time and evolved distributors. Let's say of your overall, distributor base today, how do you say, so you already achieved where you want to be, or that journey is still on in terms of the quality of distributors?
That journey is still ongoing. Right? I think all the new partners that we are deploying our effort, of course, has been, that in all the places we should work with someone who's existing A-class FMCG distributor and who's doing the right kind of coverage, going to those stores, and hence both relationship as well as logistics-wise, that's something which is very natural to them. And in 8 out of 10 cases, those are the partners that we are finding and working with. And in 2 out of 10, we still, because it's still a younger company, because in a lot of these wards, the revenue size is lesser, and we're still in a place where we have to work with probably a Class B for now, and get to a better business size which will attract a Class A to work with us. And so I think that's a journey that we are on.
And very lastly, and I'll come back in the queue. I saw in the market in August, sub 100 rupee price points, 99, 79, 49, which is the, let's say, the LUP equivalent for you, right? Which you had called out sometime back as an opportunity. And also recently there was a release in the exchange about canteen stores department. Does these results bake in already? I mean, these are already there, or these are incremental? I know that all will grow, but at least the first cut. Let's say this quarter, all this has gone into the market?
The small size packs, right, is something that we've started executing. Since I think 2 months back, right, is when they're actively gone in the market, and we now of course need to drive awareness as well on the same. So on November, Uttam Face Wash Media, we created an edit which specifically calls out that pack also. And hence I would say the action has started, but very early in terms of where it is.
Thank you so much. Good luck and God bless. Thank you. Thank you, guys. Thank you.
Thank you.
Thank you, sir.
Ladies and gentlemen, we request you to stick to one question at a time, please. We'll take our next question from the line of Shrenik B from PGIM. Please go ahead.
Hi, thanks for the opportunity. My first question was
Shrenik, can you use your handset mode, please? The audio is not very clear.
Sure. Is it better now?
A little better. Please go ahead.
Yeah. So just wanted to understand, as you highlighted that bulk of the inventory correction is done with, can we expect the normal growth path to return from 3Q onwards?
Shrenik, I think it will take us a few quarters to get the scale up of offline going, as well as to learn from the experiments in cells that we talked about on Mama and execute the same. And like I said, rest of the portfolio continues to do well, right? But these two and turning them around over the next few quarters, right, will be critical from a long-term growth perspective. So our entire focus is in that. And that said, we expect the recovery to be gradual and not sudden when it comes to getting back on the growth path that we talked.
Sure. Also, Varun, can you throw some light on the Dubai case that is ongoing, getting some updates on that? So what is the status as of now on that?
So the case is ongoing. We have a favorable judgment in Indian High Court, but in the Court of First Appeal in Dubai, the judgment has not been as favorable. And that said, our lawyers are very confident on the construct of our case. It's a simple parting with a distribution partner with the due notices that has been done, and even the in terms of the quantum of business was not as large as the downstream has been ascertained to be, and our documentation is also strong there. So at least from our lawyers, we still continue to get strong confidence that the final decision should be in our favor. We have filed for an appeal, in the High Court in Dubai, right, while the High Court appeal is already in our favor, and we continue to sort of discuss that as well.
Okay, thank you so much. That's it from my side.
Thank you. We'll take our next question from the line of Yash from Stallion Asset. Please go ahead.
Hi, thanks for the opportunity. So I just want to understand on your slide number 13, where you have given the bridge for your inventory correction impact of 63 crores. Now, I see that because of this, there's almost like a negative 10% EBITDA margin, right? So I'm just trying to understand, like, how has just about 63 crores, which is like about 12% of your Q2 FY24 revenues, because in Q2 FY24 you had 496 crores and your reported EBITDA margin was 8.1%. But because of this inventory correction impact, I think that whole margin is gone. So why is there such a big loss? I'm just trying to understand that.
Yeah, hi, this is Raman Desai. I'll dig that up. The 63 crore inventory impact means, this is returns coming back to the company. So there's an effect. It's impacted our primary sales to an extent, and hence we make 70% gross margin. So we lose that 70% gross margin on the return inventory. And along with that, given that inventory is coming from the trade, we've also provided for certain inventory-related provisions, so that if there is inventory which is coming back, which is in a certain condition, we are adequately provided for. And hence, so there's a loss of gross margin, there is an inventory provision, and also we provide certain, trade cost-related provision on top of it, which is impacting this close to 10.7% impact from a year-on-year perspective on our EBITDA margin. So that's what it's.
I would like to further add to that, like we have shown, even if this wouldn't have happened, the adjusted EBITDA is also lower compared to what our plan was, and that's largely on account of the while the overall our OPEX planning and some of the other costs, etc., on account of the short-term supply chain condition, etc., have been there. So the revenue in the scale that we expected has not, shaped up. So that is also one of the reasons why it has been more severe than it should have been. And some of that sort of stabilizes over the next quarters as well. We should be back to the normal revenue and then start growing from there as brand growth comes.
Sure. So I mean, just for your.
We have participants in the queue, please.
Sure, got it. Okay, no problems.
Thank you. We'll take our next question from the line of Manish Poddar from Invesco Asset Management. Please go ahead.
Yeah, hi, Varun. I have two questions, so I'll take them together. Given this one question thing. So just two bits. First is, if you look at the last quarter commentary, I think the called out thing was, there is like a 40 crore impact from this inventory correction. I think the number is significantly higher. So can you help me understand what explains that? And the second thing is, let's say the call happened sometime August mid, the last quarter call. And that time I thought, we were quite acquainted with, this inventory correction. And, we were wanting to put steps in place in terms of this project and other interventions. And that time we were guiding for 20% growth for the rest of the year, adjusting for this sort of inventory correction. So what really has changed in the last, let's say, 3 months, give or take, in terms of, I've heard the commentary, but I'm still not able to gather what really has gone dramatically wrong, or, what is really the underlying concern. And if possible, can you really call out, let's say, among the brands in Mamaearth, let's say if there was a 100 crore brand which has just gone down to, let's say, 10 crores, are there, cases like that? Is able to understand and appreciate the situation much better? But otherwise, if you look at the commentary of Q4 and Q1 and now, every quarter, there's a different commentary and delivery. So, I'm just trying to, trying to understand it better, not trying to push it towards the wall. Thank you.
Hi, Manish. So yes, we had called out the inventory impact of 40 to 50 crores, and as we were sort of planning for this. Like I said, the actual impact has been higher, largely because all of these, most of our understanding was from the system inventory which we were seeing just for the super stockists, but during the same period when we have actually executed this, and they've also taken inventory from sub-stockists which owed them money, and as well as to some extent in certain cases trade, and all of that has resulted in a higher net inventory take back compared to what we had estimated it to be. And from a planning execution perspective, and we after sort of the communication of this, and we realized that the current system had gotten fairly aware of us wanting to make this transition, and hence we started seeing significant friction in them wanting to execute the agenda that we needed to execute, and because of which we were seeing almost a stalemate kind of a condition. And earlier we had planned we will be able to probably phase it out and do it in a certain way, but we clearly realized that we will need to do this with a certain sense of urgency, and otherwise we will be in those stalemate positions longer than we expected to be. And I think from a brand's perspective, and of course our objective was to execute the plans that we had, right? And the hope was that the same plans should result in a different outcome when it comes to any growth. And there's been clear recognition and acceptance on the fact that okay, this is not working, and rather than trying to do the same things and expect different results, we probably need to step back, sharpen the saw, look at doing different things, because we our long-term objectives continue to remain the same, and to get there, if you need to take a different path, we must sort of take that. And in line with that, we've made some of those corrections and adjustments. And our view, like I said, still is that from a medium to long term, the destination continues to remain the same. And this is just sort of a slingshot to course correct and evolve in line with how things are sort of changing. And things do seem to be changing faster than what we imagined them to, be it in terms of urban consumption landscape or distribution landscape from QC perspective, and consumer proclivities. And that we want to make sure that we look at them all together, do our do the right kind of hypothesis testing, and sort of build a model which is able to deliver growth even on a brand like the size of Mama, and sustainably and structurally.
One more, if I can. Okay. Yeah, sure. Yeah. So just to understand, let's say if Mama sales is 100 rupees, of this, let's look at half year basis, just to get some sense, or let's say if you want to take trailing points, I'm fine with that also. Just to get some sense, in this 100 rupees, there are bits and pieces which will be growing, right? Or there are bits and pieces which would be behind. If I have to just get some caricature, let's say if you have to divide the portfolio in, let's say 4 or 5 broad categories, or percentage of portfolio which would be growing versus declining. I'm just trying to understand, are there pockets which you need to course correct, or this is broad based at a brand level? Because I think in the earlier part you mentioned some bit of intervention in the channel level. I'm just trying to look at more from a, let's say, portfolio product level, so if possible. Thank you.
Manish, my view on that would be like, I'd rather let us look at it and figure out a solve where we need to solve the same, and to generate the right kind of output which will help brand growth and growth. And I don't think sharing that level of granularity is going to help the union. And we understand the pockets where those issues are. We are, like I said, taking concentrated approaches to figure out how we will resolve those issues and turn them around. And in a couple of quarters, I think we'll be fairly confident in being able to share what all are the big changes that we are making and implement them at scale to get to where we need to get.
Sorry, come across, let's say setting out, how does one judge, let's say, the interventions you're taking and let's say the input output of it, other than let's say the quarterly results which come out. So that's where the 100% was from. But I hear you. Thank you so much.
Thank you. As there are no further questions, I now hand the call over to management team for closing comments. Over to you.
Oh, thank you. Thank you so much for asking these questions. I hope you were able to provide clarity on the interventions and changes that we are sort of looking at. And Gagan and I still continue to be super excited and confident about the opportunity that is ahead of us and our capability as a company to actually capture that opportunity. And this is more of a sharpening the saw kind of a moment for us, and where we are clearly correcting certain structural pieces to make sure that we win structurally and sustainably in this space. And we are very confident that we will come out with the right kind of answers and execute them in the best manner possible to get there.
Thank you. On behalf of JM Financial Institutional Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.